Welcome to our deep dive on why a generous cash gift for a down payment might actually threaten your mortgage approval. In this video, we'll unpack how lenders view undocumented cash, what KYC and AML mean in practice, and what you can do today to keep your home purchase on track. We'll walk step by step through sourcing, seasoning, documentation, and legal compliance, and we'll finish with practical options and pro tips. Let's get started. Here's our roadmap. First, we'll frame the down payment dilemma. Next, we'll explain why lenders care so much about documentation. Then, we'll distinguish sourcing from seasoning. After that, we'll go step by step through immediate sourcing. We'll layer in crucial compliance warnings, compare your best options at closing, test your knowledge with quick quizzes, and finally summarize the key takeaways. Here's the heart of the dilemma. A well-intended cash gift for your down payment can clash with lender requirements. Because of Know Your Customer and Anti-Money Laundering regulations, lenders must verify the legitimacy and origin of closing funds. If a large gift comes from outside the formal banking system, it triggers extra scrutiny. This friction often conflicts with cultural or traditional savings habits and can delay or even prevent a home purchase. Our goal is to translate the rules into clear actions so you can navigate this without surprises. Before we go further, a brief disclaimer. This content is for educational purposes only and does not constitute legal, tax, or mortgage advice. Policies vary by lender and jurisdiction. Always consult your loan officer, underwriter, qualified tax professional, or legal advisor regarding your specific facts and timelines. Lenders demand documentation for two main reasons. First is sourcing. They must verify that the cash is legally obtained and truly a gift, not a loan that would inflate your debt-to-income ratio. Second is seasoning. If funds have been sitting in an eligible bank account for 60 to 90 days, they're considered seasoned and may bypass the need for granular source documentation. This approach is driven by compliance. Know Your Customer and anti-money laundering regulations compel lenders to confirm that funds are legitimate. If your gift is documented well or seasoned long enough, the path to approval is much smoother. Otherwise, underwriting will ask for additional proof, which can slow or derail the loan. Let's distinguish sourcing from seasoning with a simple framework. Sourcing means tracing the origin and legality of funds and confirming they are an unconditional gift. Seasoning means those funds have been sitting in an eligible account for around 60 to 90 days. Why does this matter? If your funds are seasoned, lenders often limit extra source documentation, making approvals easier. If funds are newly deposited, expect underwriters to request gift letters, bank statements, and credible explanations. For example, a gift deposited 75 days ago may be treated as seasoned, while a gift deposited 10 days ago will trigger sourcing questions. The rule of thumb is straightforward. If you can't season, you must source. Here is a practical, step-by-step plan for immediate sourcing. First, request a lender-approved gift letter template. Second, have the giver sign the letter with key details, the amount, the date, a clear statement that it is a non-repayable, unconditional gift, and their relationship to you. Third, gather bank statements from the giver, typically the most recent 2 months. If those are unavailable, move to the next step. Obtain a consistent and credible written explanation from the giver, describing how the cash was accumulated over time through legitimate means, such as years of savings from employment. Next, deposit the funds correctly. Be aware that any single cash deposit over $10,000 triggers bank reporting. Never break the cash into smaller deposits to avoid reporting. That is, illegal structuring, and carries serious penalties. Also, determine whether the giver must file IRS Form 709 if the gift exceeds the annual exclusion, even if no tax is immediately owed. Finally, if sourcing cannot be satisfied and closing is imminent, consider proceeding without the funds and depositing them only after the mortgage closes, because lenders track only the funds used up to closing. Use this checklist to strengthen your gift letter. Include complete names and the relationship between giver and recipient. Specify the exact dollar amount and the date of the gift so lenders can match it with bank records. The letter must clearly state that the gift is non-repayable, demonstrating there is no hidden loan. Include a brief description of the source of funds or attach statements if available. Ensure signatures and contact information are present so the lender can verify details. Finally, if required, provide account details to connect the origin and destination of funds. The more precise and consistent this letter is, the smoother underwriting will be. Let's cover the non-negotiables. Any single cash deposit over $10,000 triggers a bank report, which is standard compliance, not an accusation. Do not attempt to avoid this by breaking a large amount into smaller deposits. That practice, called structuring, is illegal and may result in severe consequences. Next, consider tax compliance. The giver may need to file IRS Form 709 if the gift exceeds the annual exclusion, even if no tax is currently due. Finally, maintain a consistent paper trail. Keep dates, amounts, names, and account information aligned across the gift letter, bank statements, and explanations so underwriters can clearly follow the flow of funds. This state diagram illustrates how underwriting decisions evolve. We begin at review pending. If the underwriter identifies gaps, the file moves to a document request state. From there, several outcomes are possible. If sourcing is documented properly and the gift is clearly non-repayable, the file can move to approved. If seasoning is sufficient, but some clarifications remain, the outcome may be approved with conditions, requiring minor items before closing. If documents are missing or inconsistent, the file can be suspended awaiting documents until you provide what's needed. If the underwriter suspects illegal structuring or cannot validate the funds' legal origin, the file may be declined. The diagram emphasizes that timing, completeness, and compliance drive the outcome. This timeline shows why waiting matters. At day 0, the gift is deposited. Through days 1 to 30, the bank statements show new funds, and underwriters commonly ask for sourcing proof. Between days 31 and 60, you inch closer to seasoning, but many lenders still request documentation. From about day 61 to 90, the funds are typically considered seasoned, which often reduces sourcing requirements. The exact thresholds vary by lender and program, so confirming with your loan officer is essential. The takeaway is that time can substitute for documentation if you plan early enough. Here's a practical comparison. Strategy A is to wait and season. If you have time, allowing the funds to age 60 to 90 days usually lowers documentation friction. The trade-off is that this can delay your closing. Strategy B is to source now or exclude. Sourcing now means providing a thorough gift letter, any available statements, and a credible written explanation of how the cash was accumulated. If that still doesn't satisfy underwriting and your closing is imminent, consider excluding the funds from the transaction and proceeding without them. You can then deposit the cash after closing, since lenders only track funds used for the transaction up to closing. Your choice depends on your timeline, appetite for documentation, and lender requirements. Quiz time. Which statement best describes seasoning of funds? Option A. Showing the funds were kept in an eligible bank account for a set period, for example 60 to 90 days. Option B. Providing a signed gift letter that the funds are non-repayable. Option C. Splitting deposits to avoid reporting thresholds. Option D. Confirming the gift came from a relative. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Seasoning means the funds have sat in an eligible account for a specific period, often 60 to 90 days, making them less likely to require detailed sourcing. A gift letter, while important, addresses sourcing rather than seasoning. Splitting deposits is illegal structuring. Confirming a family relationship can help, but it does not replace seasoning. Second quiz. Is it acceptable to split a $12,000 cash gift into smaller deposits to avoid bank reporting? Option A. Yes, as long as each deposit is under $10,000. Option B. No, that's illegal structuring. Option C. Yes, if you provide a gift letter. Option D. It depends on the bank's policy. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Splitting deposits to avoid reporting thresholds is illegal structuring. Providing a gift letter or citing bank policy does not make structuring permissible. Transparency and compliance are essential to protect your loan and yourself. There is an important, sometimes controversial point. Strict documentation rules can disproportionately burden hardworking, cash-reliant savers. If immediate sourcing fails, and your closing date is near, one practical alternative is to proceed without using those funds in the transaction and deposit the cash after the mortgage closes. Lenders only track funds used up to closing, so post-closing deposits are generally not scrutinized for the loan file. To make this work, communicate early and clearly with your lender to structure the transaction without those funds. Here are the key points. Start as early as possible and plan for 60 to 90 days of seasoning if you can. Use a thorough gift letter and maintain a consistent paper trail. Avoid structuring and understand that cash deposits exceeding $10,000 will be reported by the bank. If you cannot meet sourcing requirements and time is short, consider excluding the funds from closing and depositing them afterward. Finally, verify tax requirements and lender-specific policies up front so there are no last-minute surprises. Let's wrap up. Cash gifts can help you buy a home, but only if they are properly documented or allowed to season. Sourcing proves the funds, legal origin, and that the gift is not a hidden loan, while seasoning reduces the need for detailed source proof. Avoid illegal structuring at all costs. If immediate sourcing fails and you must close soon, consider proceeding without those funds and depositing them after closing. Above all, coordinate with your lender and tax professionals early so your transaction proceeds smoothly. Thanks for watching. If this video helped, please like it, share it with someone preparing to buy a home, and subscribe for more clear, practical guides. What is your biggest mortgage question right now? Share it in the comments. We read them and may feature your question in a future video.